Hello and welcome to this episode of San Diego Real Estate Live. This is Christina Torres, and today we're talking about credit. I think it's important to not only understand what credit is and how it works, but if you're looking to buy a house, you really want to understand your credit because it's going to determine, one, if you qualify for a house, and two, the interest rate that you're going to be getting for that house. So I'm going to be doing a series on credit. I'm going to start with this, just kind of how credit works, and then just come along with me on this journey and check out some of the other videos that I'm going to be posting or that are posted about credit, just so you can maximize your knowledge, because this is going to save you a ton of money. Because if you can get your credit score where it needs to be when you get a mortgage or even credit cards or loans or any of those kinds of things, that is a big factor of the interest rate that a lender is going to give you. So let's get started. First of all, I want to make sure that you're subscribing and you're liking for more, because I love being able to give this content to you. And like I said, it's so important to make sure that your credit is in a good place. And I'm going to give you guys some tricks as well on how to maximize that. So how does credit work? So basics, right? Your credit history is a summary in the files of credit, these three credit bureaus. The three credit bureaus that report are Experian, TransUnion, and Equifax. And they basically let the lenders and these banks know how you kind of measure up when it comes to paying your bills. I highly recommend you getting some type of credit monitoring system. It's really important to have. A lot of them will let you lock your credit as well, so that if you know you're not running your credit, you don't have any fraud or anything else that could possibly happen. So, I like to just use either Experian, TransUnion, or Equifax, either one of those. They have their own credit monitoring situations as well. And there's some other credit companies out there that do credit monitoring as well. So find the one that you feel like best fits your needs, that is in your budget. 25 bucks a month is about right. You can get them to come down on the price if you just call and let them know that you need the price to be lower, because some people can't afford $25. So they will definitely do that if you call them. So subscribe to that and then call them and ask them to lower the price. Say you're going to cancel and they'll lower it. So just a little tip there. So, what information is on your credit? Okay, so just basic information, right? The number of credit cards accounts you have, your outstanding balances, the amount of loans that you have out, how much that you're paying back, if you're paying stuff back on time, if you've missed a payment, if you're late, if you've had foreclosure, bankruptcy, any kind of like car repossession or any of those things are all shown on your credit reports. And so with your credit report, there is a number. It's a 3-digit number that each bureau represents your score. And these scores can range between 400 and 900. So if you're under 400, that's super low. You might not even have a score at that point. And then, your target is kind of like that 800 range, between 700 and 800 is a great range for you to be on your credit. Now, when it comes to loans, like mortgage loans, because that's what I do, if you are a W-2 employee, 740 is tier 1. Tier 1 means that's the best score that you could have. You basically, over a 740, you're at the highest interest rate you can get in the realm of credit for that particular part of the equation when they come up with your rate that you're going to get for interest. If you're self-employed, they like to see 760. They do need it to be a little bit higher when you are self-employed. So just keep those numbers in mind when you're looking at credit scores and what your credit is. So there's 4 different types of credit that is reported. You have revolving credit, charge cards, service cards, installment cards. And just revolving credit is just the, you maybe like you have credit that that you're charging and then you're paying back, right? You have your credit cards, you have, service credit, you have, and then you have your installment credit. So installment credit is your mortgage or your car loan or your student loan. That is like a large amount of money that you took out, and you're making installments on that, that particular charge. Okay, so, why do you need credit? Good credit is necessary if you're planning on borrowing money, if you want to get a car, if you want to get a house, if you want to get, a Peloton or any of those things that you're looking to get, you definitely want to be able to have credit. So, a lot of people ask me, do I have good enough credit to buy a house? So this is kind of the look that you want to look at. So for FHA, 780 is the score that they're looking at. I mean, you can have the range between 500 and 570, but most banks are going to want to see a 580 credit score for the FHA loan. A conventional loan, you have to have a higher score, 620. And then there's a debt to income ratio factor as well that I want you to be aware of when it comes to your credit. So just understand that with credit, the higher your credit score, the better rate you're going to get. So there's going to be tiers. So say 580 is the lowest score, right? And then you go up to 600 and then you hit a tier there. Then you go up to, that 620, there's another tier, then you go to 640, there's another tier, and so on and so forth. Talk to your lender about the different tiers. Each bank is a little bit different in their tiers that they use for when you do get a bump with your rate. And you want to be able to, again, maximize your interest rate and get the best rate you possibly can. But on the other hand, if you have a 580 score or, and you're a first-time home buyer and you're trying to get into a house, if you're paying a little bit of interest at first, it's totally fine. You can always refinance, once you've had your loan for at least 6 months, you can refinance. Your score will go up because you have a mortgage loan that you've been paying, and that's going to help as well. So getting started is the most important part. I just want to really encourage you to take a look at your credit score. Another thing I want you to also understand is when you are on these credit monitoring situations, the credit score that you see for a credit card credit score is going to be a different score than you see for a car loan versus a home loan. And they just have different algorithms that they use. So I have a lot of times people will come to me and they'll be like, hey, I have the Experian app and it says I have a 690 credit, and they own their house and they're wanting to refinance. And then when I pull their credit, they have a 700. So I really encourage you to, if you are wanting to refinance or you're looking to purchase a home, find a lender that you trust and that you want to do business with, and have them look at that for you, and see where you're at. And just know that you have 90 days to search for a loan. So as long as you know that you're in the market, say you're looking to refinance, you're looking to purchase, if you are searching for a loan from that very first inquiry that you have 90 days out, you know, the banks know that you are looking for a loan. So even if you run your credit with a couple lenders, it's okay. It only is going to count as one inquiry. Once you go past that 90 days, it's going to count as another inquiry. But you can shop around, and it's not going to hurt your credit to shop around because they know that it's a mortgage loan. Same with car loans. You're able to do that as well. Now, what's going to be detrimental to your credit is if you go for credit cards, because credit cards is a whole different ball game when it comes to credit. So every single inquiry counts when you're running your credit for credit cards or store cards or any of those kinds of cards. So just keep in mind, car loans, mortgage loans, 90 days, go search, find the best deal, do what you need to do. If you're with a credit card, do not run your credit for a credit card unless you absolutely must have a credit card. And remember that inquiry stays on your credit for 2 years. So just keep that in mind. That will lower your score the more that you're running your credit when it comes to credit cards. So that is my tip on that, just to be mindful of that. You want to have at least 3 credit cards on your credit that are revolving, that they're seeing that you're making payments. And you also want to keep your lines of credit under that 6% mark. So if you take out your phone and say that your credit card limit is $5,000, right? $5,000, 6% of that is $300. So you want to make sure that when that statement posts, your amount that you owe is between $1 and $300. You don't want to pay off your card every single month because if there's a zero balance for 3 months, it goes inactive on the credit bureaus and it's not going to give you as high of a score. So you want to have at least $1 to, if it's a $5,000 one, $300. Say it's a $2,000 limit. You do 6%, or it's $120. So $1 to $120. So keep it under 6%. That is the first tier, and that will keep you in a sweet spot. The next one is 30%. So keeping your cards at 30%, that will lower your credit score a little bit, but not too much. But once you go over that 50% mark, your credit score, you're going to see, is going to significantly drop. So keep that in mind. So I wanted to also tell you guys about down pay or debt to income ratio, just so that you understand that really quick. Debt to income ratio is just the percentage of debt you have to how much you make every month. So you want to make sure that you're also looking at your credit score and you're looking at your debt to income ratio. I'm going to do another video on this so that you can really understand what this is and how this works. But I just wanted within this video for you to understand your credit and your debt to income ratio are your 2 major factors when it comes to loans and how high or low of an interest rate that you're going to get. So keep those guys in mind. So, you know, check out all of my videos, subscribe, like. Thank you so much for staying here till the end. With this San Diego Real Estate Live, I'm going to go over mortgage loans, credit, down payment, 1031 exchanges, investment properties, real estate, and more. So you definitely want to stay hooked into this because we're going to give you some great information. Again, thank you so much for joining me. I have a home buyer's guide for you if you would like. It's on homebuyersguide.sandiego.com. Go ahead and download that today so that you have that. I have some awesome information as well in it. Check out some more of my videos that I have. And if you have any questions or comments, please feel free to reach out to me or comment below in the video, and I will get back to you as soon as I can. Thank you so much, and I hope you all have a wonderful day, and stay tuned for the next video. Have a great day. Bye.